You check your credit score before you check your bank balance. You refresh the app. A number appears, 680, 720. You feel good or you feel ashamed. This number was never really about you. The real reason is much more interesting. Somehow, somewhere, someone decided that your entire financial existence could be summarized in 3 digits. Not your income, not your integrity, not whether you pay your rent on time out of love for your landlord, and not out of fear of eviction, but 3 digits. Once that number existed, banks stopped asking difficult questions. They only looked at the score. You were led to believe that this number reflects trust, but it actually reflects profitability. Let's go back to the dawn of credit scoring. Before credit scores, there was a personal touch to financing. A local banker knew your father and could tell whether he paid his debts. He knew whether you went to church, whether you got drunk, whether you were a good risk. This system was completely subjective, could be biased, could be flawed in its own ways, but it was human. Then, in 1956, an engineer and a mathematician decided to start a company called Fair, Isaac and Company. The idea was simple. What if you could predict somebody's behavior based on certain numbers? What if you could take away the human factor? What if you could make lending more efficient? Sounds reasonable, doesn't it? The banks were reluctant at first. They didn't want to take away the personal touch, but the formula had one major advantage over a loan officer's wisdom. It was completely predictable. It didn't have its own agenda, at least not on a conscious level. It could lend money to 10 different people in one day, not one. By the 1980s, FICO scores were everywhere. And somehow, lending became less about trust and more about predictability. Now, here's where it gets interesting. Your score doesn't actually reward good behavior. It rewards a very specific type of behavior, debt behavior. If you've never taken a loan, never charged anything to your credit card, never bought a car with monthly payments, you don't have a score. You have no score. The system doesn't reward financial prudence, it punishes it. In fact, a person who has a credit card but never charges anything to it and pays it off in full every month will have a lower score than somebody who charges $500 every month to 5 different credit cards and only pays the minimum payment each month. Can you believe it? Why? Because the second person is a much better predictor of future payments to the bank. They always pay something, even if it's just the 2% finance charge. Think about it. The number that determines whether you can rent an apartment or buy a house was created by the lending industry, for the lending industry, to make sure that they can take your money for as long as possible. You never knew it, but you were being scored for somebody else's benefit the whole time. This is where behavioral economics comes into play. Daniel Kahneman, an expert on behavioral psychology, has made a living explaining why people make seemingly irrational economic decisions. He has shown that people are much better at predicting their behavior in a specific context than they are at predicting their behavior in a completely different context. A credit score is a good example of the latter. It's an abstract number that most people don't really understand. You know your own behavior, but you don't really know how it translates into this number, so you change your behavior just to understand it better. You behave more predictably. You take out a loan just to have a loan. You charge $500 to your credit card just to pay it off later. You were never really scored for being a good risk. You were scored for being a good, predictable risk. It's actually quite manipulative. Richard Thaler, another behavioral economist, has made a name for himself by studying nudges or subtle manipulations that get people to behave in certain ways. This is precisely what credit scoring does. People take out loans to establish credit history because they think that will improve their score. They open store credit cards to get a 5% discount, only to realize too late that the card hurts their score. You didn't build a habit of using credit cards. The system built it for you. Now here's the really interesting part. Your score doesn't really reflect your financial situation. It reflects your engagement with the banking system. 2 people with identical bank account balances, identical levels of spending discipline, and identical savings rates will have different credit scores if they have different levels of engagement with the banking system. During the 2008 crisis, millions of people with good credit scores found themselves in financial distress after defaulting on mortgages they could not afford. This was because their credit scores were misleading. They suggested these people were good risks when, in reality, they were not. The scoring system failed because it was not designed to identify good risks. It was designed to identify people who consistently paid their debts on time in the past, regardless of their overall financial situation. After the crisis, many economists were left wondering why the system failed so spectacularly. The answer was simple: it was designed to fail. It was designed to reward people for paying their debts on time, not to reward people for taking responsible financial decisions. The credit score is a lot like the market price, in that it reflects opinions rather than objective reality. It reflects the opinion of the person who invented it, who knew that people would use it to make financial decisions. It reflects the opinion of the lender, who thinks they know your financial future based on the limited information they have. This is why Ben Graham, the father of value investing, said that price and value are often completely different things. Your credit score is a price. It is not a value. So what is your score doing to you? It's influencing you. Landlords check it before renting you an apartment. Employers check it before hiring you in some states. Insurers check it before giving you cheap car insurance. Your score dictates how much you pay for everything from apartments to jobs to health insurance. A number designed to help lenders make better financial decisions has ultimately dictated almost every aspect of your financial life. And the worst part is that you have little control over how this number is calculated, but you have complete responsibility for your financial future. You are graded on a scale that only the banks can see, and this grade follows you everywhere. This is the part that few people realize. The credit score doesn't actually lie about debt. It lies about the value of debt. It treats responsible use of debt as a virtue and reckless use of debt as a vice. It rewards the person who takes out a loan and pays it back on time, while punishing the person who does not take out a loan at all. Once you understand this, you will realize how much the financial system has manipulated you. You will realize that building your credit has been presented to you as a moral obligation when it really is an incentive to take out more loans. Building your credit has been framed as a virtuous habit, similar to eating your vegetables and exercising. Building your credit almost always means taking out a loan on more favorable terms so that the lender can benefit from you. None of this means you should ignore your score. In fact, in a world where everything is relative, ignoring your score could be even more detrimental. If you have a low credit score, you will pay much higher interest rates on loans, be denied credit cards, pay higher security deposits for apartments, and so on. The number is real. It has tangible consequences, even if the interpretation of the number is wrong. Understanding what your score actually means can help you use it to your advantage. You should treat a high credit score as a sign that you are financially useful to lenders, rather than a sign that you are a responsible steward of your wealth. The two are completely different things, and the culture around credit scores has made us believe they are the same. The culture around credit scoring has made us believe that the person who takes out a loan and pays it back on time is somehow better than the person who does not take out a loan at all, when in reality they are just different. Keynes was once asked what he thought about markets, and he said that they could stay irrational much longer than you could stay solvent. The credit scoring system is similar in that it doesn't have to be rational to be successful. It just has to be consistent long enough for everyone to believe it reflects reality, at which point it actually does reflect reality. The system is designed to keep you in debt for as long as possible, because the longer you're in debt, the more money you pay to the lenders. You pay for the privilege of using their money to buy things you want to buy. The system is designed to fail, to mislead, to keep you in debt. But as long as you keep playing by its rules, it will keep rewarding you. And the next time you look at that number on your screen, remember that it's not really about you.